The Biden administration has just announced an initiative to make half of the U.S. auto fleet electric by 2030. This is great for the electric car industry, but how can investors capitalize on this news? We've built an AI focused on helping investors. We called it Hedgy. We asked Hedgy to predict which electric vehicle-related stocks will have the best 12-month returns. To accomplish this, we've asked Hedgy to analyze all the constituents of the Global X Autonomous and Electric Vehicles ETF, known as DRIV because its ticker is DRIV. DRIV seeks to invest in companies involved in the development of autonomous vehicle technology, electric vehicles, and EV components and materials. This includes companies involved in the development of autonomous vehicle software and hardware, as well as companies that produce EVs, EV components, such as lithium batteries, and critical EV materials, such as lithium and cobalt. DRIV has an annual fee of 70 basis points, which translate to an investment cost of 7% over 10 years. That's how much you pay to the ETF provider. That means the provider of this ETF takes 7% of your investment every 10 years. Hedgy has analyzed all 77 underlying companies that the ETF has invested in and has predicted their 12 months return. As you can see, many companies are predicted to produce negative returns relative to the market average. Our philosophy is why pay a fee to own poor-performing stocks when you can own just the top performers without a fee. Hedgy's analysis of all 77 companies allows our users to pick the top-performing stocks and eliminating the need to buy the ETF and pay the fees. If you follow us, you know that Hedgy's artificial intelligence uses the following 4 gauges to predict market relative returns. Machine-learned industry-specific gauges are cheapness, profitability, sentiment, and momentum. The Hedgy Analytics platform provides users tools to understand the investment worth of the entire ETF based on its holdings. The sentiment of the DRIV ETF is the bottom-up aggregation of the sentiment of its holdings. The profitability of DRIV is the bottom-up median of its holdings profitability. This is also true for momentum and cheapness. The platform charts the history of these 4 bottom-up gauges to understand the investment value of each ETF. In this chart, we provide a historic view of the aggregated median scores of all of DRIV's underlying companies. DRIV's cheapness and profitability have been trending down over the past few years, but both have an upward trajectory in the past few months. Cheapness has a current score of 45. Recall that a score over 60 means that the ETF presents a good value. Profitability is slightly higher with a score of 40, 7 out of 100. A score over 60 means the ETF has strong profitability. DRIV's sentiment score is currently at 67 and trending down after a sharp rise to a historical high toward the end of 2020. Momentum has been trending up in the past 12 months. It currently sits at 71 out of 100. Our artificial intelligence has shown that the best time to buy into an investment theme is when all 4 aggregated bottom-up gauges are above 60. It may not be the right time to buy DRIV, but it may be a good time to buy a few of its holdings. Let's examine Hedgy's predictions for its top 3 performers. Now that we understand what is being analyzed, let's review Hedgy's top 3 EV-related stocks. Number 3 on the EV stocks, top 3 list is Apple. Ticker AAPL. Along with the Apple products that we all know and love, Apple launched a vehicle project in 2014 called Project Titan that focuses on building an autonomous driving car. Reuters has said Apple is aiming for a 2024 delivery, but Apple analyst Ming-Chi Kuo believes a car won't launch until 2025 to 2027 at the earliest. Hedgy rates Apple as an industry buy in technology hardware, storage, and peripherals. Our return forecast is for Apple to outperform the market average returns by 23% in the next 12 months. Number 2 on our EV stock top 3 list is Qualcomm. Ticker QCOM. Along with semiconductors, Qualcomm has promising tech for wireless electric vehicle charging. Also known as WEVC, it is hailed as a no-fuss, simple solution for charging electric and hybrid vehicles. Hedgy rates Qualcomm as an industry buy in the semiconductor and semiconductor equipment industry. Our return forecast is for QCOM to outperform the market average returns by 24% in the next 12 months. And Hedgy's number one electric vehicle stock is American Axle Manufacturing Holdings. Ticker AXL. American Axle is headquartered in Detroit, Michigan, and is an American manufacturer of automobile driveline and drivetrain components and systems. Hedgy rates AXL as an industry outperform in auto components. Our return forecast is for American Axle to outperform the market average returns by 24% in the next 12 months. There you have it, Hedgy's top 3 EV stocks. Thanks for joining. You can review the entire report by clicking the link provided in the comments of the video description. If you found this video useful, or if you already use hedgyanalytics.com, please follow this account for more Hedgy top 3 lists and tips on how to get the most out of Hedgy Analytics.